We are back with our weekly market review where we analyze the stock market to see if a correction or crash is coming. Because you know at Fallible, we're always looking at the potential downside in the market so that we could protect our money. That's the most important thing in this game, not losing money. So first we're going to go over the general stock market to see what's going on, and then we also got a stock that you should be taking a look at and possibly be adding to your watch list. And from there I'm going to answer a big question that I've been getting lately, and it's a pretty good question, and it should help you with managing your risk going forward. So let's jump into it. As always, we're using our research from MacroOps, our global macro research and consulting firm. And we're going to start out with the Bank of America Global Fund Manager Survey. And to sum it up in one word, investor sentiment is unambiguously bullish. And you remember why we always look at sentiment, right? It's one of the best indicators in the market, more than the fundamentals or the earnings or any of that. In markets, you're always trying to play the player. So play the other investors that are investing alongside with you. So when it comes to sentiment, when people are too bullish, it's actually a bad thing. Because if they're super bullish, then they already have all their money invested in the market, and then what is left to push prices higher? Whereas if they're bearish, then that's actually a good sign for the market, because it means a lot of people have cash on the sidelines that still has to come into the market. So in this case, as we said, investor sentiment is unambiguously bullish. COVID is no longer the number one tail risk. Instead, now people are thinking about inflation and taper tantrums. You remember that from back in, 2013, the taper tantrums? Basically, every time the economy started looking good, people were worried that, hey, the Fed might pull back all their stimulus. So what's going to happen? And I mean, the market hasn't really changed that much from then. We're still doing the same thing, where good news is bad news for the stock market. Good news in the economy means the Fed might pull back. And we're dealing with that right now, once again, except in rates, which we'll talk about in a second here. The V-shaped recovery we're having is inducing a jump in rate expectations. So people are piling into cyclicals. And this is the biggest drop in tech exposure in 15 years. And this goes back to what we've been seeing in bonds, right? The price of bonds has been falling drastically. I'll give you some interesting stats about that here in a second. But when bond prices fall, interest rates go up. And those interest rates rising because bond prices were falling, they've been absolutely crushing these tech stocks, which is why the NASDAQ looks like this. It's a mess. And that's because the valuation models to value these tech stocks, they get all screwed up when you increase the interest rates, because you got to value each of these stocks lower. So that's why you see their prices dropping now. Another thing that's happening is that investors are allocating way more money to commodities. They're at an all-time high now. They're long stocks and short bonds. And that's what we talk about here. Investors are beginning to crowd onto one side of the boat yet again. And that side is the bullish reflationary short rates in USD and long commodities and value side. So notice here, none of that is good for tech stocks. You can see here a record amount of investors expect a stronger economy now. This goes back to the sentiment, right? Everyone's on one side. Everyone's super bullish. The profit expectation, this is the global profits that everyone thinks they're going to improve. You can see they're at highs we haven't seen in a long time, since December 2009, even February 2002. Super bullish. This is a chart just showing how big the allocation to commodities has become. The allocation is the highest ever. And again, that's the reflation idea, where everyone thinks inflation is coming back, so commodity prices should shoot up. Everyone also thinks that value will outperform growth stocks going forward. See this? New highs again. But what do we know about markets as a general rule? We know that they're always going to try to screw over as many people as possible. So whenever you see something like this, all the investors piling on one side of the boat, that's where things start to tip. And that's where you should be looking at the other side. Because when everyone thinks one way, the market generally likes to do the opposite. So we'll see how long these trades actually last. Now, overall, there are good reasons to be bullish in this market, as we've said in all the past videos for a few years now. We are long-term bulls. We have that paradigm shift at the Fed and that fiscal shift from our government. And the shifts we're talking about are the Fed leaning with the wind, meaning if the economy is running well, they're just going to try to stimulate it more. All stuff that will once again boost everything. But even though that's happening, we could be nearing the point where the market has discounted all the good news and then some. So JP Morgan wrote that the whatever it takes mindset that lifted markets in 2020 now risks becoming a too much of a good thing that creates recurring drawdowns in the 2021-2022 via rethinks on inflation and Fed policy. And this is kind of what we're seeing now, which we talked about in the last video, where the Fed came out and said, hey, we are going to keep rates low. We're going to keep things easy for a long time. But the market isn't believing what the Fed said. They don't believe Jerome anymore. They think that things are getting so good that the Fed is going to have to backtrack on what they're saying right now. And that's when, instead of stimulating the economy more, they're going to try and slow it down. And that's when interest rates would rise. So the market is a future discounting mechanism, right? So it's always going to try to front run whatever the Fed is saying. So if the market thinks, hey, the Fed is wrong and they're going to have to backtrack, well, that's where you're going to see these bonds keep plummeting and rates keep rising. So the market is basically rising rates before the Fed even does it, because they think they know what's going to happen before the the Fed does. And in that case, it's funny because it becomes a self-fulfilling prophecy, right? If you're trying to front run the Fed and you raise interest rates yourself, then that in turn will slow down the economy. So what you're trying to front run actually accelerates the process faster. And that's the nature of markets. It's all reflexive. That's why it's so complicated. So once again, to reiterate, the risk is that ample fiscal and a booming recovery get the Fed to back away from its pro-cyclical policy stance. And that would make the bond market respond with violent rate increases, just like that 2013 taper tantrum, which we were talking about before. Now, all that being said about interest rates, we are kind of hitting an intermediate bottom here. So you can see this chart, which is the 10-year yield over the 40-day moving average spread. And we shared this 4 months ago, saying we had to run all the way up to this red line up to this red line. They're both red. But you can see we've done that. So now it looks like it might be time for a reversal in yields because they are now stretched to the upside. So you've been kind of seeing a little rebound right here in bond prices. And remember, bond prices going up, then yields would go down. So we've been seeing that play out a little bit. And the question is, does it keep going? Because it has been a ridiculous fall lower, right? Markets don't just move in a straight line. They trend and then they mean revert. So you got to expect, movement like this. So if we do get that retracement and yields calm down a little bit and stop going up so drastically, we might catch a break in the market too. But as you can see so far, when I'm recording this, markets are still falling. They're struggling. It's just sideways chop. Short-term breadth in the NASDAQ is actually near a critical juncture. So this is super blurry, but this is the breadth of the NASDAQ. You can see it hit a low here and bounced. So this level, this red line, it needs to hold if the NASDAQ is going to stay up. And breadth is just the number of stocks going up versus the number of stocks going down. To have a healthy market, you want more stocks going up than going down, and you don't want just a few stocks dragging along the entire index to positive gains. You want the whole market moving together. That is a stronger, healthier market. So that's why we track breadth here. So we need to make sure that it holds this level. If it doesn't, and if it breaks lower this week or the next, then it's going to open us up to much greater downside. So that is something to watch for sure. A few side notes. One is housing. There is a strong bull case for housing right now. In the middle of last year, we released a report talking about the demographic tailwinds and the incredibly tight supply. So a lot of younger millennials finally buying houses at a time where there's not enough houses built. So what does that mean? Strong demand, low supply, that's going to push prices up. So inventory remains extremely tight. There are only 2 months of supply in both the new and existing home market. And new construction is not keeping pace with household formation. So this is all good news if you're trying to invest in housing stocks. And one more side note, Bitcoin, just to get people talking in the comments, because people hate when I mention this, but there's a lot of research that shows that it is the most unenvironmentally friendly asset. So Bank of America talks about how there was a ridiculous increase in CO2 emissions in the past 2 years. But what's worrying is how much it's affected by dollar capital inflows. So their calculations show that rising Bitcoin prices could push Bitcoin CO2 emissions to levels rivaling some of the largest economies in the world. This comes at an enormous cost with arguably a limited social purpose. So whether you agree with this or not, because I know there's a lot of debate about it, it doesn't matter because the government can use this point to help tamper down Bitcoin. Because we always talk about how the government does not want to give power to anyone. They want to keep all of it. And the control of the currency is a large power that, of course they want to keep that. So you're going to see a lot of arguments against Bitcoin coming from them. The environmental aspect is just one more. Now going back to the general market, we got some interesting stats here. The Barclays US Long Treasury Index has seen its worst drawdown in 40 plus years. So this whole dip we're seeing here is no joke. This is historic here, 40 plus years. Another interesting point is that the ISM is now over 60, which typically leads to weak returns over the subsequent 3 to 6 months in the stock market. You can see right here, the average S&P 500 returns are negative. The reason being is that a high ISM means a hot economy, which means a repricing of growth and rates, which is exactly what's happening, right? We just talked about that. And fast rising yields don't often bode well for stocks over the short to intermediate term. A weak equity market then reverses flows back into safety, bonds, and then the process begins again, wash, rinse, and repeat. So another good market concept to understand is that stocks and bonds compete for capital. So it's a constant cycle between the two. So when you see rates rise, bonds actually become more attractive relative to stocks, because we know bonds are safer than stocks, right? But the problem all this time is that bonds, their rates have been so low that you can't put money there because you won't get a return. So everyone was in stocks. But if all of a sudden interest rates are increasing and bonds are giving a return, then it becomes more attractive because people are like, hey, this is a safer bet and I'm still getting a return. So all of a sudden you see money flowing out of stocks into bonds. But then what happens? If a bunch of money is going into bonds, bond prices rise and then interest rates come down again. And if they come down, then they're less attractive and people are like, hey, I need to go back into stocks. So they pile back into stocks. And then bond prices in return fall and interest rates go up and then money flows back over there. And then that's how you kind of get that cycle, because they both compete. So that's something to keep in mind mind here as we see this bond market acting so crazy. And it's another reason why the higher the yields, the worse off for the stock market, because money is going to be flowing out. Another interesting thing is that the S&P 500 is now up 77% off its March lows. And this is the exact percentage gain that the market saw off its 2009 lows back in the day, before it experienced its first significant pullback. So you can see in this chart right here, we had a 77% increase and then a huge dip. Same thing might happen again. Now, like I said, there are a few stocks that we're looking at considering what's going on in the rates market. You can see here, yield curves around the world continue to steepen, meaning rates are going up. And this is driving some recent outperformance from financial stocks, because steeper curves and higher long-term interest rates translate into greater net interest margins, because banks borrow short and lend long. So basically what banks do is they borrow at the short-term interest rate, which is lower, and then lend on a longer time frame, like giving you a loan, on a higher interest rate. Now it gets a little more complicated than that. I didn't fully explain it, but basically banks profit more when this spread changes. So steeper curves are good for them, which leads us to Japanese financials in particular. One of the best looking ones that we've been tracking at MacroOps is Nomura Holdings, NMR. You can see on its monthly basis down here, it's broken out of a 12-year bottoming wedge, and it has 11 years of improving earnings per share. So this is a huge pattern and breakout, and it's definitely something you should be watching. Now, going back to the general market, like we said, we're in for some sideways movement or a correction. That's what it kind of looks like. But long term, we are still bullish. So a big question I've been getting lately is about why I'm in cash if I'm long-term bullish. Well, here's the thing. When I say I'm in cash, I mean that my system, our Fallible system, has put us in cash, which has been a good move considering how volatile and sideways this market has been. Now, our system, it focuses heavily on risk management, which again, that's our main thing at Fallible, right? So of course our systems are going to do the same thing. So what happens is that there are going to be periods where we're all in cash, but we may still be bullish for the market over the long term. The only issue is that we can't be sure. So proper risk management means that you are going to go in all cash, sell your positions, respect your stops, because you really don't know. Now, this doesn't mean that we're staying in cash. We are going to redeploy and test the waters once again. It's actually going to happen in a few days here. But of course, the question always comes, why get into cash? Again, if you think the market is long-term bullish, just stay in. Well, here's a great quote from Nassim Taleb that explains what I'm saying here. He said, "My lesson from Soros is to start every meeting at my boutique by convincing everyone that we are a bunch of idiots who know nothing and are mistake prone. But we happen to be endowed with the rare privilege of knowing it." So what is Nassim saying here? Well, I'll give you it in terms of our research for MacroOps. We do all this fancy research, right? We do this video every week going over our latest views on the stock market. But at the end of the day, we know we could very well be wrong. No matter how smart we are still not that smart. That's how you got to approach the market. The market is always smarter. Things can always happen that you don't expect. Never start drinking your own Kool-Aid. And that's also why when things get shaky and our risk parameters are hit, we exit and get into cash, even if we think long-term the market is still bullish. That is proper risk management. Because what do we think right now? We think the market is going to go sideways to a bit lower, but then continue its bull, right? But what if that doesn't happen? What if this is a top right here? What if this turns into a topping pattern and then collapses 50%? Well, if that happens, then who even cares about our fancy bull thesis and all these stats that we're running off? At the end of the day, the only thing that matters is what the market is doing. And that's why, yeah, we do have great research and we put a lot of time in, but we also know we cannot predict markets. You got to stay humble. You got to realize that you're going to be wrong a lot. That's why you manage risk so you can survive and keep playing, because you only need to be right a few times really. And that's where all the money comes from. So like I said, in a few days here, our system is going to re-enter the market and kind of test the waters. Now, I'll be honest with you, it could turn out bad. We could take some losses real quick, because like we said, from our analysis, it looks like the market is shaky, but again, we don't actually know. So you got to follow your system. And when our system is saying go test the waters a bit, that's what we're going to do. And there have been so many times in the past where I was feeling just like this, like, oh, things look shaky, but I follow my system, I invest, and things take off. And that's where I make all the money. So this is where investing becomes difficult, because you got your opinions, you got your emotions, and then you got your system too. And usually all those things are saying different things. So it comes down to who is able to execute and who is able to cut through the BS. That's where long-term success in the market actually comes from. So anyway, if you want to see how our team does it and how our Fallible strategy works, then we got a training right here that will teach you it step by step. And now is a great time to have a system because markets are so shaky. You need that risk control in place. So I'll put a link to this training in this video and down below in the description and comments. Definitely check it out. This is why we use systems, because markets are by definition uncertain. You're always going to be dealing with that uncertainty. So you need the system that has certain risk management, because that is the one thing you can control. So once again, if you want to see how we do it, then just click this link right here. Same strategy I use and all our Fallible members use as well, and we are very happy with it. So click here and I I will see you in that training.